All right, Kevin. I'm so honored to have you today here. And it's a pleasure for me as a Venezuelan guy and representing my community to have you here. So the first question that I have for you is, how's your Spanish?
I took 2 years of Spanish in high school, but it's pretty poor. So, buenos dias. That's about all I know.
All right. So next interview we're gonna do in Spanish. You better be practicing to me, okay?
Okay.
So
See,
yes. so for the people that don't know you well, could you please tell us more about your background? Like I know it's a very extensive book, so you can please be a short summary.
okay. So my background is engineering. I have an undergrad degree in actually aerospace engineering. And so my first career out of college was actually in that field. And I was in there for about 20 years or so in some various companies. And what happened was just in my free time, I kind of got bitten by the investing slash trading bug, which I'm sure a lot of people who are listening feel the same way, where they want to figure out ways to beat the market and to make money that way. And so I did that on a part-time basis for a whole bunch of years, most of it unsuccessfully. And then I started to get better really when I started to do what's now called algo trading, algorithmic trading. It's just trading by a set of rules. But once I started to do that, I started to do a lot better. I finished first or second place a number of years ago in a trading contest, which is the same trading contest that actually Larry Williams won back in the 80s. He did a ton better than I did, but I still was able to finish in first place one year, second place 2 other years. And around that time, I started to feel like I knew what I was doing in trading, and talked to my wife, and she agreed, hey, if you want to do this full time, go for it. And that was, I think, around 2008 or so. And ever since then, I've been trading full time. And then around 2014 or so, I wrote what was my first book at the time. And based on that, people started to come to me and say, hey, can you teach me how to trade? And so now I do education kind of on the side, in addition to my full-time trading. So that's kind of my background in a nutshell.
I have a couple of questions for you in regards to the World Trading Cup. So you
Sure.
won in futures, correct?
Correct.
Okay. Do you use Algos for that competition or was it manual trading that you
Uh,
did?
no, so what I did was I actually created an algo. It was one particular algo with different parameters for some different markets. So I traded I think about 6 to 8 markets. I don't recall right offhand, but it was a pure algo based. At the time, nobody called them algos, but it was all just going by the rules. And I remember back then I couldn't automate it just the way the broker was set up, who ran the contest. So I was calling in orders every day, but it was still, I was taking the orders that the strategy actually told me to take. So even though it wasn't automated, it was still a rule based kind of approach.
So in regards to the same competition, so it's been quite some time after that competition. What do you think you learned from that competition? That of course the competition is completely different than the real world when investing. We all know because positional sizing, all these things are completely different. But what did you learn from that experience?
Well, the biggest thing I learned from it was to have goals for where you want to be. And so was a good example, because I saw this contest and I thought, wow, if I can do good in this contest, this will kind of prove to me that, maybe I could really do trading, as a full-time thing. This was back when I was doing it part-time. So I went back and looked at the records. I might have even called the broker up and asked for some of the past standings. And I looked at what the top 3 people did for previous years as far as percent return. And it turned out around 100% return over the course of a year would be good, usually for about 3rd place or so. And I thought, hey, that's a pretty realistic goal to shoot for. You know, if I aim for 100%, I probably will finish in the top 3. I wasn't hoping to win because, you know, sometimes the winners just had hundreds of percent, but I thought, hey, that would be pretty good. So that was my goal. I said 100% a year, develop a strategy that returns 100% a year. And I went to it and built a strategy that in testing, you know, in the historical back testing, and I did simulations and all this stuff, it came out to be about 100%. And so with that in place, I entered the contest. And those 3 years I was in it, it was 2005, 6, and 7. Each of those years, I got over 100% return. So I was able to meet that goal. So that turned out to be the biggest lesson. It wasn't, you know, how to build good strategies, although that was part of it, but it was really having a goal out there and then designing something to achieve that goal.
Yeah, that's wonderful. Now let's move to the next topic, which is going to be, I think it was in 2014 when you wrote your first book. Is that correct?
Yes, yes.
Okay, building a winning algorithmic trading system. I had the opportunity to read it, and it's a fascinating book. So, what inspired to write that book?
Actually, the publisher approached me and said, we realize, you know, you have a pretty good following out there and you had this success in the contest, although it was, you know, a few years ago from when I wrote it. I started writing the book, I think in 2012 or 2013. So it had already been a few years, but they approached me and said, hey, would you like to write a book? And I thought, well, you know, writing a book doesn't make you a whole lot of money, you know, unless you're a fiction author. You know, they can make money, but if you're writing nonfiction and a book on trading, yeah, there's just not much money into it. And I realized that up front. And so I said, well, I'm going to use this opportunity to document what I do, and that will help me. And it actually really did. Just writing the book helped me to kind of solidify some weak points in my development process. And it just overall really made what I was doing a lot better. So in that respect, just writing the book was a big benefit to me. But it took probably about a year or so between the writing and the editing and all that. So it really was more of a labor of love than something to make money at.
Okay, that's wonderful. So is another question that I have for you today, which is very interesting because you love Algos, and also I love Algos too. Well, when you study for the CMT, one of the chapters that you need to study very well is a market efficient hypothesis. What are your thoughts on that? Because you know it's a big topic, but what do you think?
Well, you know, if the market was truly efficient, I don't think any of us would have any chance. You know, there'd be no way to find little edges. And yet with algos, you can find edges. Now, the problem with them is they don't last. A lot of times they don't last, or a lot of times they're very hard to trade, meaning you'll find something that works, but it also has to endure a big drawdown to get it. So I have some strategies, for example, that are profitable overall, but I know they're going to go through drawdowns, and that makes it tough to trade. And so in that respect, Sometimes when I think, hey, the market's just random, it certainly feels like it, because there'll be times where things just go up and down and just kind of meander, and you don't really get any kind of traction in your trading. But then all of a sudden, like let's just say 2020 in March and April, a bunch of markets just took off, and that turned out to be a great time for me. So whatever was going on right then definitely wasn't random. But I would say a lot of the times markets probably are, to an extent, just very efficient and more or less random noise.
Okay. So and now, of course, there's I believe there is a very important topic, but not everyone understands this topic. So I would like your opinion on this because I know you have a strong opinion. It's about risk management because
Uh-huh.
it's a big topic, but everyone focus just on the training system. They spend probably 90% on the training system and just 10% on risk management. In my opinion, should be as equal or more important for at least for my personal experience. So what are your thoughts on that?
Um, yeah, I don't know if I would say it's a 90-10 or anything like that, but it's certainly, you've got to have both. So what I always tell people that I work with is, to be successful at trading, you need two things. You need strategies that make money, or a strategy, preferably strategies. So you need positive expectancy strategies, and you've got to have a disciplined approach to trading them. And that's where the risk management comes in. So if you have just one, you're going to fail. If you just have strategies that make money, but you have terrible risk management, you're going to fail. And if you just have great risk management, but you don't have strategies that make money, you're going to fail it too. So you've really got to have both. And what it comes down to for a lot of retail traders is the risk management for them is making sure they don't risk too much. In other words, that their account size is big enough to handle whatever they're trading. And for a lot of people, it's just one contract. And I'm amazed there's so many quote unquote gurus out there who talk about trading 10, 20, 50 ES contracts and that kind of thing. And they get people all excited about trading all that. I'll tell you what, I've never traded that many ES contracts, but trading even one contract, if you do it correctly, can still give you a nice return and help you build an account up. But the key is you've got to have proper account sizing for that. And that's kind of related to the risk management, so, hey, I trade one contract, but I'm not going to try to use intraday margins, because I realize that one big move can just wipe me out if I have a small account. You want to make sure you stay in the game, because over and over again, the thing I see with uh, retail traders especially is they're just underfunded. They'll try trading too much for the account size they have, and they should be trading maybe even a tenth of what they're trading. And that's what's nice about the new micro ES, the micro mini ES, and because it's 1/10 of the size, and so people can get in a little smaller and so be a little more comfortable. But I would definitely agree that people don't spend enough time with the risk management. That most people are worried about looking at a chart and seeing a higher high, and or where can I draw the trend line, or what does the MACD say, and those kind of things. And yeah, that's important, but making sure you stay in the game is just as important, and that's the risk management part.
Okay, that's wonderful. And I hope everyone understand this from Kevin's experience, which is very. How long have you been trading for?
Probably over, I want to say between part-time and full-time over 30 years. So almost right out of college, I started
Wow.
doing some kind of trading.
And
And
what's something what's going on right now that people want to jump in trading without thinking this is like a hobby first and then small income and then maybe you can consider it as a career because you're a full-time trader. So there's like a step. So you apparently did that process, right?
right, right. And it was hard. I mean, and every day you have a losing day, even when you're doing it full time, you start to have doubts of like, uh-oh, is this the end? Is this the start of just me losing money forever? So
You
it's
blew up any account?
uh, starting out, sure did.
Everyone does,
For me,
right?
yeah. I mean, I remember my first account. I started with $5,000 and it was a very short period of time. I think I lost like $3,000 of it, and I was just like panic stricken, because that was all I had, and to lose 60% of your account was just terrible. But I've gone through that. I've gone through margin calls where I was working full time and I'd go to the bank at lunch to wire more money. I mean, it was crazy some of the things I did. But luckily, I learned and got away from some of those bad habits, which I guess is the key.
Okay, I think I have the similar paths, and especially when I came to the US, I said I can just be a full-time trader and doing from my apartment. It doesn't work in that way, so I'm learning from that. So let me ask you this. So let's talk about the Algos, which is your passion. Um, when you're doing your background, sorry, your back testing, okay. So how important is for you to use all the data and do Monte Carlo analysis? I know you referring that in all your books, but I want the people that don't know Monte Carlo analysis, so you can please tell us more about that.
Sure. So the way I develop systems, I use like a multi-step process, and so uh, part of that process is after I've done like the major part of my testing, which I use walk forward testing. It's a technique to get out of sample results. Uh, I have an equity curve then that looks like my historical back test. Okay. And what that only tells you so much. It doesn't tell you everything you need to know. It's good to know, but if you were to take the same trades that made up that equity curve and just put them in a different order, you could get drastically different results. And so the theory behind Monte Carlo simulation is you do just that. You take all the trades that make up your historical equity curve and then basically randomize them and pick them to create 1,000 different equity curves that are all based on the same data. And when you do that, you can get some statistics of, okay, well, this should be my worst drawdown, and this should be my average return, and this should be my return to drawdown, the ratio of the two. And by doing that, you get a much better feel for your system and what to expect out of it. So just to give you an example, if you did a back test and had an equity curve, and it let's say it has some drawdowns, but it goes upward and to the right, and it makes money over, let's say, 10 years. Most people would look at that and say, okay, well, this is a money-making system. Then they'd go and trade it live. And let's say the first 3 or 4 months they start trading it live, it loses money. Well, then they start to have doubt and they think, oh, well, this system wasn't that good. It should be making money. Something's wrong. My broker's bad, all kinds of excuses. But really, depending on the system, it might have been just random chance and just a string of bad luck that caused you to lose money, and your system might be fine. And doing the Monte Carlo helps you understand that, and it helps you realize hey, if I trade this system for a year, there's a 80% chance I'll make money or a 90% chance I'll make money, but it's not an absolute. And one thing I always tell people that I talk to, traders I talk to, is you've got to start thinking in probability terms to be a
Mhm.
good trader. You can't think in certainty. You know, we live in an age where you turn on the business news and somebody will be on there saying why the stock market fell and why something happened. And they sound so confident and so certain, you know, this is why this happened. And the fact is, they're usually after the fact making up excuses or reasons why something happened. And two, when they predict the future, uh, most of those experts are terrible at predicting the future. And you know how that relates to the average trader is you've got to stop believing in certainty that, oh, this happened, so tomorrow the stock market's going to go up. You don't know that. You got to, and when you start thinking in terms of probability, you actually become a much better trader because you realize, even though you have a great system or a great risk management or whatever, that you could still lose money in the short run. And
That's correct.
that's
And that's
really important.
that's what you study when the in CMT, the martingale
Yep.
principle with the 50-50%. That's very interesting. Also, when you're saying the system might be failing for 3 months, also people need to check the large number theory where you develop, based on data and try to let it run and see if it might. So let me ask you this, because this is, I know that some people ask it for this because we know that we develop the algorithm and then we need to put it into life. So there are some BPS. So do you have any recommendation that people want to use it? Because sometimes some of them or those companies will fail because they're like not planning to shut it down, and so you have the platform running 24/7 and might be some trouble. So you have any experience with BPS?
Um, I personally, I don't use it unless I'm like traveling for an extended period of time. But that question does come up a lot. Of, hey, does my platform have to be running? And the answer is yes. You know, you have to have your platform running somewhere, unless you have a broker uh, who you've given your code to, who runs your signals for you. And there are some brokers that do that. Of course, there's a cost involved with it. So for most people, it's either, hey, you do it on your home PC, but and that's what I do most of the time. But I have a backup internet source. I have backup batteries. I have a backup whole house generator in case things go bad. So I have a lot to protect me there. And a lot of people just say, hey, I just want to run it on the cloud, you know, use a virtual private server, and they'll run it there. And I know quite a few people who do that, and you know, they just remote in every once in a while and see how their things are going. So it's for me, it would be something that when I travel more, I'd look at doing that. But otherwise, I kind of just keep it uh, at home.
Okay. Okay, that's a valid question, a valid answer. So also have a question for you here is how important are the slippage and commission when you're developing the algo? So you take those into consideration, or?
Yeah, they're huge, and it's kind of a pet peeve of mine. I actually, it's kind of funny. I used to present pretty regularly at a webinar that had a whole bunch of different speakers, and um, I always say, hey, you got to include slippage and commission, because some of the other people don't. And it was funny. The organizer one time said he got a question from somebody who asked about slippage and commission. He said, I knew it was one of your fans, because he said you got to have slippage and commission. So apparently my constant saying you need slippage and commission included has hit home with a lot of people, and there's a couple of reasons for it. And the first one, obviously, if you don't have slippage and commission, you're going to get really unrealistic results. And the last thing you want when you're building a back test and looking at results is to kind of think you can attain something that you're never going to get. So that's part of it. The better estimates you have of costs, the more realistic your back test, the better off you're going to be. Now, the second part is a little more subtle, and it has to do with when you're optimizing or picking the best case from all your back tests. If you don't have slippage and commission, an optimizer, what it's going to try to do most of the time is either optimize, let's say, net profit or minimize drawdown. In the end, what it does is it's going to trade a lot more. It's going to lead you to have more trades in your back test than you'd otherwise have. Where if you have the proper amount of slippage and commission, it usually leads to fewer trades. And that turns out to be the best case, which actually is pretty good, because you don't want to be trading 50 times a day, at least as a retail trader. I don't think there's any benefit in that, because you're going to be paying, even if you get a seat at the exchange, you lease a seat, you're still going to be paying a lot of commissions. And anytime you're not using limit orders, you're going to get a lot of slippage. And so just to overcome those costs, just to break even, is huge. So I like slippage and commission all the time in my testing. And I found out it works very well. The trick is to know what slippage to use for different markets, because slippage on the ES, the mini S&P, is a whole lot different than the amount of slippage on coffee, which is a lot more slippage. Or if anybody out there trading lumber, the slippage on lumber is ginormous. And I don't even have an algo for lumber. I wish I did, because it's a really, especially it was last summer where it was going, I think it was last summer, it was going crazy. But the slippage, at one point I'd calculated it, and I think it was like $250 per contract per round turn. So it was a huge amount of slippage that you'd have to overcome just to break even. And so, yeah, I as you can tell, I feel pretty strongly about having slippage and commission. Commission's not as bad, because most brokers are around the same amount, unless you go to like a full service broker, which most algo traders don't. But the slippage is something, it's just amazing. I've actually gotten in internet fights with people. I remember one guy, for lack of a better word, he claimed he could buy and sell natural gas with market orders and not have any slippage. And it's just,
who is that guy?
Yeah.
I don't even know him.
It's just crazy somebody would actually say this. And the funny thing was, people who didn't know better believed him. And I brought up, hey, you need slippage, and everybody else is like, no, you don't. He says you don't. And I'm like, oh boy. But yeah, so for anybody out there testing, more realistic with slippage, and it will lead you to less trades, which I think is going to be better for you, because there'll be less cost to overcome to actually turn a profit.
So like, I don't know if you had these stats, like comparing swing trading strategies versus day trader strategy. So in terms of commission, I believe there's a big gap there. So do you have any stats on that, or?
I don't, but I mean, a lot of brokers will give you big breaks, if you're trading 10 times a day. But I don't think when you're doing that kind of trading, the commissions are going to be what kills you. It's going to be that slippage when your stop order gets hit and you lose a few ticks on that. Just a couple weeks ago, it was Martin Luther King Day, so it was about a month ago, I was in a gold strategy, I was only trading one contract with this strategy, but it was on a Sunday night when, it was a holiday weekend and gold plummeted like 10 or 20 points, like within a minute or something. And of course, that's right when my algo I believe it tried to enter short. And I ended up getting over 14 points of slippage,
Wow.
which is $1,400. And of course, I sold almost at the bottom of that like spike, and then market went back up and I lost. So I would have lost on the trade anyways, but what the killer was, I lost an extra $1,400 just because of slippage. So uh, kind of what I've found is the more you go to this swing trading, which just goes days to weeks, you're not trading as much, and that's helping to minimize slippage. And for me, that seems to be the sweet spot. I know people are always, hey, I want to do 10 trades a day and make, $500 a day. I'd love to do that, but I've just never found algos that really work consistently over a long period of time in those kind of real short time frames.
Okay, that's great explanation. Also, moving to the next topic, because I would like your opinion on this, is the trading systems. So when you're gonna compare, for instance, trend following system versus counter trend systems. So in regards to efficiency for the future and looking for the correlation or this correlation between the system in order to minimize the risk, how important is that for you?
It's pretty important. Now, I don't necessarily look at what kind of system I have when I develop it. I mean, sometimes I'll go in, I'll say I want a trend following system, or I really want to do some kind of mean reversion thing. But a lot of times I'll just try ideas, and I won't necessarily put them in any basket of, oh, this one's a seasonal type approach or anything like that. But what I will look at are the end results. So regardless of what kind of system it is, I'm looking at, let's say, the weekly results of that system over 5 to 10 year period, usually like a 10-year period, and putting that in a portfolio with other systems I'm trading and see what it does to the overall equity curve. Is that new system causing bigger drawdowns or longer drawdowns, or is it kind of making things even out? And that's what I really focus on, is the correlation between all those systems. And so I look at them sometimes. There's a couple different ways to do it. Sometimes I will look at it uh, system versus system. So let's say I have 10 systems. I'm going to look at number one versus number two. How are they correlated? And then number one versus number three, and so on. You go through all through it. And ones that are highly correlated, you say, hey, maybe I don't want to trade those. The other way to do it is just to limit the amount of systems you have in any one particular market or market sector. So for example, if I have two gold systems and a copper system, I may not want to add another gold system or another silver system to my portfolio, because I realize if there's a big trend in gold, chances are it's going to be a big trend in silver, and chances are it might be one in copper too. Not all the time, but so now all of a sudden, if I'm on the wrong side of that trend, and that's what I always worry about, uh, I might be too correlated. So maybe I don't want to do all those. So I tend to look at correlation a couple different ways. And the easiest way for most people is just, hey, try to trade some unique markets or market sectors.
So yeah, so now it was last year developing an algo. What I found was when I was doing the back testing, the algo work in one market but then I tried the same strategy in a different market, it didn't work. Do you think that's one of the reasons why that happened?
It could be. Uh, my philosophy on that. So I mentioned earlier when I won the World Cup contest, I was trading one strategy, 8 different markets, and just different parameters for each one. So I was I was basically using the same strategy. Now, years later, uh, I don't do that as much. I almost don't do it at all. If I find a system that works, say with the euro, I will try it with other markets because uh, I have more confidence. Hey, it worked in the euro. Now let's say it works in cocoa, for example. And I'm like, wow, that's kind of neat. This works in a couple different markets. And that gives me some confidence, but it's not something that I demand that, hey, a strategy must work in 5 different markets or 10 different markets. And I know there are people out there who feel that way, but uh, what I've seen is most of my algos will work on one particular market. And even then, maybe it works with 60-minute bars of the euro, but 90-minute bars, it falls apart. And I have that. And, it doesn't necessarily make me feel good. I'd rather have it work on the 90, maybe not as good, but um, I think that's kind of the reality of it because different time frames, there's different people entering and different market players, and the same thing with different markets. Somebody might trade only the euro and they might not be in some other market. And so maybe what they're doing is what you're picking up on with your algo. It's, a lot of it is really unknown. It's hard to say.
Okay, so I have a 3 questions here from one of my friends. So I think they're really good questions. I'm gonna ask you. My
Okay.
friend's name is Andres Trujillo, who's CMT. Is one of your is a big fan of you. So he asked you, what are your thoughts on dynamic position and sizing to improve performance?
Well, it's one of those things that can be dangerous. And the reason I say that is it's not just dynamic position sizing. It could be pretty much any position sizing. The tendency, what a lot of people do is they'll develop a strategy and then and they'll like the strategy with like one contract, okay, and then they'll say, well, now I have to put some position sizing on it to maximize what I'm going to be making with it, okay, and that makes tons of sense. I get it. Well, what they'll do is they'll try some different approaches. So maybe they'll try some dynamic position sizing. Maybe they'll try using optimal F position sizing, some different things, and they'll find one that works the best based on their back test, and they'll say, oh, I got it. I got the perfect strategy and I got the best position sizing for it, and they'll go off and use it. And then things fall apart and they wonder what happened. And what happens with a lot of people is what they've just done is they've just optimized their position sizing method, which is just as bad as optimizing for the strategy itself. So the way to get around that would be just to say, hey, I'm going to use, let's say, dynamic position sizing, and I'm going to use it on all my strategies and not try to optimize it or do anything like that. And if it works decently in back tests, you don't try to optimize it, then I'd feel comfortable going forward with it. But there's a big trap there that uh, people fall into with position sizing, and they think there's a best way to do it. Dr. Van Tharp, who was one of Jack Schwager's market wizards, he wrote a book on it was called The Definitive Guide to Position Sizing or something like that. And I think he has over 100 position sizing methods. And I've actually had people borrow my book and take it and use it to find the best position sizing for their strategies. And I tell them, don't do that. But that's what a lot of people do. So you just got to, with any kind of position sizing, you just have to be careful you're not optimizing with it. And that's, I think, the big key.
Okay. So, another question is how relevant is, or I would like to understand more about when you're developing the algo, is the difference between the market orders and limit orders. So, is that something that you consider?
Well, most of the systems I develop are market orders. And the reason is because I want to make sure I get in the market. Now, this isn't as bad as it used to be. So, back when I started, there were limits. There were daily limits that were pretty tight. There's still daily limits on a lot of markets, but today they're really expanded. So, like back in the day, I think wheat, for example, was maybe 20 points. And then if it went too far, you'd be in a lock limit situation. And so sometimes what I found when doing tests with limit orders is you couldn't get in it. And actually, if you have a lock limit, you wouldn't be able to get in with a market order. But the issue seemed to be worse with limit orders. The nice thing about limit orders is you get your price that you want. But the bad thing is sometimes the market will hit your price and take off. So if you're doing back testing, the key point there is to make sure you only assume limit orders are filled if your price is exceeded. So, if you say I want to buy at 100, make sure the price goes down to 99.9 and then you'll be guaranteed to fill. Because if the price just hits 100 and then takes off from there, you may or may not get filled. So that's part of the issue with limit orders. The other part is if you're trading multiple contracts with them and you go live, and let's just say you go live with 3 contracts with a limit order, you might get filled on 1 or 2, but not that third one. And so then you've got to ask yourself, well, what does that do to your strategy? Do you jump in with the market order to even it out? And how does your algo react? And it usually is a little bit trickier with limit orders. And so the market orders, yeah, you pay the slippage, but what I found, it's a lot easier to keep things in sync, especially when you're trading real time.
Yeah. And the last question that I got for you is what are your thoughts on the equity curve and equity curve trading? Do you have any macro rules like emergency breaks to avoid expanding the account drawn down?
Yeah, equity curve trading is one of those really neat theories that in reality, just I've never really seen work. And every time I've seen somebody who's claimed that it works, I've dug into it, and it turns out they were doing something wrong. Calculation wise, it's real easy, and because I've done it myself, it's real easy to mess up the calculation for equity curve trading. And what you accidentally do is you turn off the strategy before the trade that would tell you to quit. And there's been 2 occasions that CTAs, so commodity trading advisors, I mean, guys who are professionals, they both were doing it. And the one in particular, I remember he had a US 30-year bond system, and he said, oh, it's a pretty good system, but I put this equity curve trading on it and it makes it so much better. And, you should invest money with me, or we should work together. And I said, well, let me look at it, because I knew, I said, there's got to be something wrong. And I saw what he was doing, and he just had a spreadsheet error where he should have been turning off his system a trade later than he was, or earlier, I forget. But basically, he was cheating, and not intentionally, but he was cheating. So I brought that to his attention, got him to agree to it, and then he finally, even then, it showed equity curve trading was worse than his normal system. He still claimed it was better. I'm like, oh, okay, we can't work together because you don't understand, or you refuse to understand it. And so a number of years ago, there used to be a magazine. It was called Futures Magazine. Then it became Modern Trader. And I wrote a couple articles on equity curve trading and basically concluded that, hey, it doesn't work. And I got a sort of nasty phone call and emails from this guy who was an assistant editor there, who claimed he was the quote unquote father of equity curve trading. I didn't know. I didn't know there was a father of equity curve trading, but apparently this guy had claimed that. And he was trying to get me to kind of backtrack on the articles and say that he was right and mine were wrong. And it never got anywhere because I said, I'd love to believe it. I'd love to believe equity curve trading works, but the reality is I just have not found it useful. The only thing that is sort of related to equity curve trading that I have used is if you look at the max historical drawdown in a back test and say it's $5,000, you use that as your cutoff point from your equity curve. So if your equity curve from its high when your real trading ever drops $5,000, maybe it's time to just turn off the system, because now you have your biggest drawdown ever. And that's usually not a good thing for a trading strategy. You know, you definitely have to come up with a way to quit a trading strategy. But from what I've seen, equity curve trading, turning it on and off, you know, what it seems to do is it'll get you, as it's going down, you'll lose money. It'll tell you to stop, you'll stop. The system will turn around, start going up. You won't be in it until that equity curve trading tells you to turn it back on, and then you'll turn it back on and you'll miss most of that run up that occurred. But that being said, anybody out there who says, hey, equity curve trading's working for me and it's great, here's how to do it, send me an email, please. I'd love to learn.
Yeah, that's amazing.
I mean, the whole theory of it just sounds so great. I mean, it's every time I look at it, I have such high hopes, and they're always been dashed. And because I bet I've tried half a dozen times over the years, and you know, I have some trader friends who still claim it works, but I've just never been able to do it. So you know, I'm always looking to improve, and that would be one thing to improve if you could actually do it.
Well, thank you. Thank you for your time. So just wrapping up here. How can people find you? I know you have your website, but tell us more about what people can find your website.
Okay. My website's kjtradingsystems.com. You can look for me there, and you know, my website's there. If you go to YouTube, just search for my name, Kevin Davey, and you'll find my YouTube channel, which I have tons. I think I have close to 100 trading videos of different topics. And usually in the description, there's links to my website. And then, of course, you can always email me. It's kdavey@kjtradingsystems.com. You know, feel free to email me. And people can also find me if they're on Twitter. They can KJ Trading. They can look for me there. So there's a bunch of different ways to find me.
Oh, that's wonderful. And the last question I have for you is, when I was talking to Ralph Ping about Optimal F, about the Trading World Cup, he told me that Larry Williams in a year got 11,000%, correct? But he also got 900% drown down. Do you still remember you drowned down during the World Cup?
Yeah, it was nothing. It was nothing like that. But the year I won, I know I had, I believe, a 50 or 60% drawdown.
Wow.
And so I think I started out, it was a $15,000 account. And I think at one point I was down to like $7,500 before it really took off. But that all goes back to my goal. You know, my goal was to get 100% return. And I realized to do that, I basically had to risk most of the account that I could have a huge drawdown. And, you know, because that's, hey, if you're going for 100% returns, sooner or later, I think you're going to have, you know, a drawdown around 50% or more. That wouldn't be uncommon. You know, it's very hard to get 100% return with a 2% drawdown, and at least to do it consistently. Maybe you get lucky one year and have very little drawdown, but you're taking on a lot of risk to get that kind of return. And people, I don't think enough people realize that there's that risk part of it. So it shows up as drawdown, but it also shows up uh, where it doesn't show up, I should say. It's just hidden. And maybe you just got lucky, but you were taking big risks.
There's
That's
no free lunch, right?
exactly. I wish
Did you
there was.
did you sleep well during that time?
Yeah, I think so, because it wasn't the only account I had. I was doing some other trading, and you know, I'd gone into it eyes wide open, and I said, "This is what I'm going to risk, and we'll see what happens." And as it turned out, it worked out in my favor.
Yeah, because actually, Ralph being he was sharing with me that during the competition too, some nights like Larry called him like at 2 a.m. Hey, how's that? That you know, the people think it's just it's not an easy thing to do, and I really appreciate what you had done for all the training community. Can be now thankful for. I hope you want. Do you have any plans for writing another book? Is coming out, or what's your plan for the next?
So my first book was a big book, and what I've done since then is self-publish some smaller books. So they're about a third of the size, and I've written 3 of those so far, and those you can find on Amazon. They're really inexpensive, and I'm in the process of writing another book, which is going to be it's going to be sort of a intermediate level for algo traders of just some studies I've done. So for example, and some of these you'll be able to find versions of them on my website, like what exits have I found work the best? What kind of risk control can you do? You know, things like that. And I'm going to put it into a book form and make a short book. And they're almost going to be, I don't want to call them essays, but they're going to be little studies that people can, algo traders can use to improve parts of their algo trading. So, you know, if they're thinking, oh man, I have trouble with exits. Well, there'll be a chapter on all the back tests I've done with exits and give you some things to think about. So, and that, hopefully if things go right, I might have that out in springtime.
All right. So on behalf of my community, I really appreciate your time today, and I hope to have another interview during this year.
All
So,
right. Well, thanks, Juan. It's been great. You have some really great questions. So keeps me on my toes. I like that.